Hello everyone, and welcome to Unit 4 of our education series, Stock Investing 101. Today's video has four main goals. The first one is to explore the reasons behind learning about assets and liabilities. Secondly, we aim to define what assets are. The third objective is to clarify the concept of liabilities. Lastly, we will tackle the question of whether or not debt can be considered an asset. Let's start with our first objective. You might be wondering why I should learn about assets and liability for stock investment. Understanding a company's assets and liabilities can help investors identify potential risks and opportunities during stock investment. With the knowledge of assets and liabilities, they can evaluate a company's financial health and performance. For example, if a company has a large amount of cash on hand, which is an asset, it may have the ability to invest in new products or technologies that could drive future growth. On the other hand, if a company has a large amount of liabilities, it may be more difficult for the company to make a profit and pay dividends to shareholders. Overall, understanding a company's assets and liabilities can provide important insights into its financial health, which can affect investors' perception of the company, which impact its stock price. Let's move on to our second objective. What are assets? Robert Kiyosaki, the author of the book Rich Dad Poor Dad, has defined assets in simple terms. Asset is something that puts money in your pocket. An asset has a value, which produces income or appreciation. Essentially, anything that is capable of generating future economic benefits can be considered an asset. Assets are an essential part of personal finance, business finance, and investing. They provide a way to generate income and increase wealth over time. Understanding how to properly manage and invest in assets can lead to long-term financial stability and success. An asset can take many forms. Let's say you own a rental property. This property generates a positive cash flow through rent payments, and its value is appreciating over time. In this case, the rental property would be considered an asset. Assets are generally classified into two categories, tangible and intangible. Tangible assets are physical objects that have value. Examples of tangible assets are real estate properties, stocks and bonds, commodities such as gold, silver, art and collectibles, vehicles and machinery. Intangible assets are valuable non-physical assets. Examples of intangible assets are intellectual property such as patents, trademarks, or copyrights, company brands and logos, software and technology. And the last one is customer lists and business relationships. Let's talk about what is liability. Obligations and debts we owe are a liability. A liability takes money out of your pocket instead of producing it. It is usually a monetary burden on an individual or a company who has to repay either a lump sum or in installments over a period of time. Let's imagine George purchased a boat for $100,000. He took a loan and paid $2,000 as a monthly payment. Boat's maintenance and miscellaneous also add up to $500 per month. Due to depreciation, the boat's value decreased over time. And, after 2 years, George sold the boat at $50,000. When George sold the boat, he could only recoup a portion of what he had initially paid for it, resulting in a loss. In this example, the boat loan and the ongoing maintenance expenses created a financial obligation for George, making the boat a liability. Examples of liabilities are mortgages, car loans, student loans, credit card debt, personal loans, and tax liabilities. Now you might be wondering, how do investors differentiate between an asset and a liability? Robert Kiyosaki proposes a strategy to distinguish between assets and liabilities by asking the question: if you stopped working, what brings money in and what pulls money out? This approach highlights the contrast between assets and liabilities. It is crucial to comprehend these two concepts for those who aspire to become intelligent investors. Always remember, assets are possessions that can produce income or be sold for a profit, while liabilities refer to debts owed to others. In the next part of this video, we will discuss, can debt be an asset? The answer is Yes, debt can be an asset. But it all depends on the cash flow it is generating. Rich people use debt to generate positive cash flow. They are mindful of the difference between good debt and bad debt, and strategically use loans to acquire income generating assets. You just need to remember one golden rule. Positive cash flow puts money in your pocket, which is profit. On the other hand, negative cash flow takes money out of your pocket and is also called loss. Here are two examples of how you can use debt to generate more profit. 1. Investing in growth. You can use debt to invest in growth opportunities such as expanding operations, acquiring another company, or investing in research and development. By leveraging debt, you can make these investments without diverting too much of its existing cash flow, which can help to accelerate growth and generate more income in the long run. 2. Financing assets. You can also use debt to finance assets such as equipment, machinery, or real estate, which in return can generate positive cash flow for you. However, it's important to note that using debt as an asset can be risky. You must have a solid plan in place to generate returns that are greater than the cost of the debt, and be able to make the required debt payments on time. Failing to do so can lead to increased debt burden and financial distress. In conclusion, while debt is generally viewed as a negative financial burden, it can be used as an asset to generate more income if used strategically and with a solid plan in place. Let's summarize the key takeaways from this lesson. Takeaway number 1: asset puts money in your pocket. And liability takes money out of your pocket. Takeaway number 2: debt can be good or bad depending on cash flow. Takeaway number 3: by comparing a company's assets to its liabilities, investors can get a sense of whether the company is in a strong financial position or if it may be at risk of defaulting on its debts. Thank you for watching. We hope this video helped you understand the difference between assets and liabilities. We would love to hear your personal definition of assets and liabilities, so feel free to share in the comments section below. If you found this content helpful, we kindly ask that you give us a thumbs up and consider subscribing to our channel for more informative videos on investing.